Hello YouTube family. Let's talk about something that's been on everyone's mind. The new coronavirus. Is this the big one? Honestly, it's hard to say, but it's moving fast and it doesn't look good. What started in the city of Wuhan in early December 2019 has grown into a global health emergency. And as the infection is spreading beyond China, so is the fear. I'm really afraid that the virus might infect me or my family members. But this virus is already infecting the stock markets of the world. In December 2019, a new respiratory illness known as COVID-19, caused by a novel coronavirus, was first detected in the central Chinese city of Wuhan. Within the first 5 weeks of the outbreak, tens of thousands of people were infected and more than 1,000 died. The outbreak has been categorized as a public health emergency by the World Health Organization. Not surprisingly, the virus is having economic impacts throughout the world. The major stock markets are failing. Major companies like Apple, Starbucks, and McDonald's closed stores in China, and airlines around the world have canceled flights to and from the region. On January 31st, 2020, the Dow stock market dropped more than 2% during the coronavirus fear, wiping out everything gained in the month of January. How miserable is that? However, the US stock market seemed to quickly recover, hitting a new all-time high on February 12th, even as the coronavirus spread. But the worst isn't over yet. The world stock markets are stumbling as more and more coronavirus cases are arising in China, Iran, Korea, and the US. The virus has spread to over 88 countries apart from just China, alarming public health authorities across the world. It's not clear how much the virus will impact the US investors, but the effects could go deeper than just retail and travel, hitting sectors and industries you might not expect, like energy, automotive, and banking. As the world's biggest importer of oil, China is a major player in the energy sector. The Lunar New Year typically leads to an increase in demand for jet fuel and gasoline. Instead, demand for oil in China dropped 20% in the weeks immediately after the outbreak, and the price for crude oil dropped about 16% between the outbreak and early February. This is putting some strain on American oil companies. Hence, the stock markets are dropping day by day. China doesn't buy much oil from American exporters, roughly 2% only, but oil prices are set at a global level, so lower prices means lower profits. Companies like ExxonMobil and Chevron saw share prices drop in the first 6 weeks of 2020. At least one firm has downgraded its outlook on oil from strong to neutral, and it says further downgrade may happen in the future due to consistent loss. The coronavirus is also slowing down many automakers. Dozens of car makers across the world work with Chinese suppliers to produce parts for their vehicles, but many of those shops have closed as part of mandatory isolation. This could result in some factory plant closures. For example, Fiat Chrysler has warned that some European plants may close if the interruption to the supply chain continues. In addition to supply chain disruptions, automakers may also face decreased demand. China may face a shocking next few months, as importers may delay buying cars. The high level of exposure to Chinese suppliers and customers could add risk to the automotive securities. Isolation is a must. As more and more countries isolate themselves from each other, more stock markets will fail. While there may be several factors at play, many major manufacturers have started seeing steep declines in share prices since the outbreak became widely reported. Microsoft, PayPal, and Standard Chartered all forecast disappointing profits. Facebook canceled its annual developer conference in California, where the company usually unveils its new products to thousands of software engineers and entrepreneurs. Banking stock market is another industry that's facing uncertainty with the coronavirus. In recent decades, the US and Chinese economies have become increasingly intertwined, so US companies often turn to banks to fund their expansion into China. Growth in China has been stalling in recent years, down from a high of around 14% in 2007. Coronavirus could slow growth even more, up to around even 3.7%. Makes you sad. If growth continues to slow down, US banks could feel the tension. Lower economic growth could lead to lower demand for loans, mergers, and purchases, meaning potentially lower earnings for banks. And when the bank's earnings fall, the whole economy of the country collapses. With all the uncertainty, consider having a plan to secure yourself against risk. For example, some investors might use exchange-traded funds or future contracts as part of their hedging strategy. You can also look at what sectors you're invested in and make sure your holdings are diversified enough to withstand any turbulence. Either way, consider your ideal risk and return parameters, and set a clear exit strategy in case you're wrong. Most importantly, keep your eyes on longer-term trends. What's going to happen next? Ultimately, we can only predict because we don't know how coronavirus will affect the economy in the long term. We do, however, know that more than 400 companies have talked about coronavirus in their quarterly earnings calls. But stocks go up and stocks go down, and then usually they go up again. So wash your hands and try to stay calm. Being aware of the potential sector and industry impacts of the coronavirus can help you prepare your future investments in stock markets. Hey, thanks for sticking through the whole video. I hope you learned something new from it. Leave a suggestion in the comments for what you want our next video to be about. Make sure to hit that like and press subscribe for more future videos. And hit that bell to make sure you're notified about future uploads. Till the next video, stay safe and see you later.